Good morning, everyone. Welcome to our Thursday morning trading room. So the market's just opened up, and it looks like it's been kind of another quiet night and relatively quiet day yesterday. Take a look here at the Eagle. We did have some swings. Certainly the moves were large enough that we could capitalize on them. This was a signal right out of the open yesterday. The market rallied up, hit the profit objective, reversed, came down a little bit. We didn't get a signal here on the Eagle. This would have been more obvious on one of our other tools, the Hawk or the Falcon. And then we just kind of went sideways for a little while. Not a whole lot happening through the European session, and here we are opening up pretty much where we left off. You can see, according to the trade forecaster, we're currently in swing mode with scalp mode hot on the heels in about 15 minutes or so. Fantastic. Marlene's in the room here, and she's going to save me a whole lot of typing. Okay, Marlene sent me a question. Excuse me, I'm still fighting off this cold. Marlene asked me to identify the higher probability signals with the Eagle and the Raptor, because as the tools have been used over the years, and as room members such as yourselves have input, we've refined some of the early signals, the signals at least that are put out with the manuals. So we still have those basic signals that you can draw on, but there are some refinements, and there's nothing going on in the market at the moment. So let's do that. Let's take a look here at the Eagle, and let's see if we can't identify some high probability trades. Now, I'm going to have to roll back here a little bit. With the Eagle, as with most of the tools, generally speaking, the first signal that produces after the cloud changes direction tends to be a high probability signal. Now, very often this trend change signal right here needs to be preceded by a test of the extreme, a retest. That's what tends to make it a better signal. You can see in this instance, we didn't really get one, however. So let me see if I can find you a better example. One other thing before I pass this section. With the Eagle in particular, it's kind of important to keep context in mind. So if you're looking at a chart like this, you'll notice that we have a trend change signal right here. We have a rule of three signal, which I'll get into in a moment. We have had a retest of the lows and a failure, so there's every indication that the market's going to try to head higher from here. Or at least that's how it looks until you take the context into consideration. The context of this is that the market is stuck. It's stuck going sideways. It's been stuck going sideways for about the last 10 hours. That's significant. So while a market will eventually break out, if the context is such that the market is sideways, you will be much better off allowing the market to break and then look for that signal, or the retest, pardon me, and the signal after the retest. Same thing here to the downside. If the market breaks, allow it to retest and look for the signal. because otherwise what's going to happen is you're just going to end up taking a false, you're just going to end up taking a false signal, and the market will eventually reverse on you and stop you out. Now, even if you had bought this signal, let's say you decided, okay, the market's going to go. If you had bought this signal, your initial stop would probably be, or you would try to keep it as far back as you could. Let's say you managed to put it below this swing. So the market begins to rally, it comes down, it fails. It finds new support, it starts to rally up again. Well, once it starts to rally up again, you would probably bring your stops in here. So the market goes up, it comes down, it tries to rally up again. Certainly, if you haven't rolled your stops at that point, you would roll your stops at this point. The point I'm trying to make here is that even though the trade did not work and you got stopped out, your actual loss would probably be half of what your initial risk was. So let's say you're like me and your average position is about $300. You would have been stopped out for about 150, which is certainly a little bit more palatable, and it does make it a little bit easier to take that trade. But let's take a look here what happens when the market finally gets outside of this trading range. Oh, look at that. It breaks out. There's the retest, and now here's the signal. And now we're able to actually, realize a little bit of a profit on this trade. All right, so context, a little bit important when you're looking at some of these signals. If you're looking at a chart, let me clean this up because it's getting very confusing now. If you're looking at a chart that is just totally sideways like this, and you look back and you say, wow, they've been going sideways like this for 10 or 11 hours, go ahead and let it break. Look at your other tools. All right, so having said that, let me see if I can find you a quality signal. Part of the reason we haven't, or I haven't put together a cheat sheet for the Eagle or the Raptor is it's been difficult to find all the quality signals in one screenshot. And I know I'm probably going to end up having to do some cutting and pasting to get you guys a cheat sheet. But here we go. This is a better trend change signal for the Eagle. This one right here. This is usually how it shapes up. So we have a market that seems to be trying to get on a little bit of a trend. You could look at the test of the extreme two ways here. First, I'll show you the more immediate test of the extreme. It's that one right there. This is really the last chance the sellers had to recover the market. And once you get that pivot in and the cloud changing direction, now you want to get more bullish. All right. So you could have looked at your test of the extreme there, or you also had a larger one here where the market tried to do one of these larger recoveries. Again, it failed and it started heading higher. Even if we did not get this little retest, this little mini one in here, this big one would have been enough for me had the market gone up to here and produced a buy signal. That would have been enough for me to try to buy the market up. Okay, so that's signal number one. That's your basic trend change type signal with the Eagle. With the Eagle, we found that a very high probability signal occurs when the market encounters the hard edge. And very often when the market gets into the hard edge, the bar color is going to change. And in the case of a downtrend, we're going to be looking for a green bar combination with a sell signal. This is what we call the green bar sell. So we have one right here. We have one a little bit later. And we have another one right here. The green bar sell, or its inverse, the red bar buy, which we're going to find in an uptrend here in a moment, always occurs in a trending market. All right, so it's not likely that you're going to see a decent green bar sell in a sideways market. The market's going to appear to at least have a little bit of a trend to it. The green bar sell also typically develops in this bear flag type formation. You're going to see a little bit of a pullback happening like this, and it's more or less going to have this type of shape to it. The market's not going to spend too much time going sideways. These channels will tend not to be looking like this, right? They're not going to be sideways channels. They're going to be more like bear flags. All right, that's the green bar sell, very high probability signal. And as you probably noticed from this one down here, we don't want to see too many green bar sells within a trend. So the first one is going to be probably one of your better opportunities. The second one, usually probably pretty good. If you generate a third one or a fourth one, you're going to start to get a little suspicious, because what's happening here every time the market produces a green bar sell is, according to the Eagle, the momentum has shifted, right? So here the market has come down, and now the buyers start to come in. You see these hollow body bars? The buyers are pushing, the buyers are pushing, the buyers are pushing. We have like 5 hollow body bars there in a row. However, they're still red. So even though the market is trying to rally, according to the Eagle, the market bias is still bearish. Then we kind of trade bars here for a little bit. Then we see the market again attempt to rally. But what happens now is all of a sudden some of the criteria for producing the Eagle bars has changed, and now all of a sudden the bars are becoming more bullish, like seriously bullish, because now they're printing green. The green bar sell is really the last effort on the part of the sellers to recover the market. If the sellers fail at this point, the market will very likely go bullish. So within the space of a couple of bars, all of a sudden the sellers get their act together, excuse me, and they're able to change the sell criteria, or the criteria for the Eagle, from a bullish bias to actually producing a sell signal. Now, there's only so many times that this will happen before the buyers finally end up overwhelming the sellers. That's why I say the first one is usually pretty safe. The second one is usually pretty safe. As you start to get into the third and the fourth, and maybe even a fifth in a very protracted trend, you should start to get a little bit suspicious. You should get a little bit leery. It's not that you may not end up taking the signal, but maybe you're going to take the signal. Maybe you're going to dial down the risk. You know, maybe just throw a onesie in. Maybe you're going to manage the trade a little more aggressively. You know, you're going to do things to protect yourself, so that if the trade does fail, well, you know, at least you didn't lose as much as you normally would. And maybe, again, you would have managed your trade a little bit more aggressively. Maybe you would have even been stopped down here, it looks like, for about $60, maybe $70. All right? So there's certain things that you look for with that green bar sell. Now, I would still consider this one a green bar sell, even though technically you'll notice that the band has gone slightly bullish. You should not try to micromanage this. Remember, whenever the market encounters the hard edge, we do Okay, how's that? Better? Sorry. I'm not entirely sure when the audio cut out. It looks like only about a minute ago, so let me just review the last point here. So what I was saying is with this green, I would still consider this to be a green bar sell, even though technically the band has turned bullish. You should not try to micromanage these things. When the market encounters the hard edge, we do expect a reaction. We don't always know how big the reaction will be, but we do always anticipate a reaction when the market hits the hard edge. And you can see in this particular trend, it was quite an extensive trend. We actually had 5 green bar sells. So we had one here, another one here, there's 3, there's 4, and then finally number 5 is the one where the sellers started to lose their grip on the market. All right, so there's the green bar sell, very high probability signal. Again, almost one of these signals that I'll take almost without exception. Here is just your regular hard edge bounce. A hard edge bounce is still a probable signal because, of course, when the market encounters the hard edge, we do expect a reaction. Out of the hard edge bounce and the green bar sell, I have a little bit more confidence in the green bar sell. So if you're looking for your highest probability reactionary signal, I would say it's that one right there, the green bar sell. All right, so we've done your basic trend change signal. So see the cloud changes. Here's your first signal that produces when the trend changes. It was preceded by a test of the extreme, a retest of the highs, and a failure. The cloud changes direction, and this is essentially your first in-sync signal. You know, similar, we have a first in-sync signal with the hawk, the falcon. Well, this is our everything's in sync signal with the eagle. After that, we have our green bar sell, and we have our hard edge bounce. All right, the last real signal that we look for on the eagle is what we call the rule of 3. And again, I gotta try to scout around here a little bit, try to find you a quality one. All right, didn't have to go too far. Right here. The rule of 3 tends to occur near the end of a, well, it occurs at the end of a trend. Oops, wrong tool. It occurs at the end of the trend, And what happens is the market starts to produce counter-trend signals. So we have got a bullish band, and yet prices are dipping low enough that all of a sudden we're starting to produce sell signals. So uptrend, market comes down, hits the hard edge. Oh, we produce a sell signal. Rallies up, comes down, produces another sell signal. Rallies up, comes down, produces another sell signal. Generally speaking, this will happen 3 times before the market reverses and starts going the other way. Hence the rule of 3. I typically become more interested after the second one, especially if it, well, this is true for a rule of 3 regardless. A rule of 3 must always be preceded by a test of the extreme. Always, always, always. In this instance right here, we've only had 2 counter-trend signals, but we have had a retest of the high and a failure, right? It's starting to head lower. The bulls are struggling to keep control of this market. Excuse me, I got a sneeze coming on here. 1 second. Okay, sorry about that. And Marlene, I'm going to answer your question here in just a second about the red bar buy. But first, let me point out that the rule of 3 is always preceded by a retest of the highs. Always, always, always. So when I'm following this chart and all of a sudden I get this sort of thing happening where I've got 2 signals against the hard edge, a failure against the high, I would be looking at possibly shorting. Now, I wouldn't short it right here on that signal. I would probably wait until the market took out the low. Why? Because, well, we're still in an uptrend. There's still a chance the market may try to recover this trend. I don't want to get stuck selling right here only to see the market turn around and resume the trend. However, if it takes out the low, I can have a lot more confidence that the market is going to fully reverse. Now, when I get the third one, however, now things get to be a little bit more aggressive. I could certainly still short from here. However, since this third signal produced at or below where the last signal was, I would be more aggressive. And if I didn't take the signal right here, I would certainly take it on a second push entry. You can tell from this bar that what very likely happened is the market came down, engaged the signal, rallied all the way up here, at which point I probably would have placed my order below the low of this bar. Using my logic counter, I could tell where the bar would finish. And if the market was truly reversing and the momentum would be on my side, well, then I could look at entering on a move lower. And you can see that in this case, you still took a little bit of heat, but it worked out pretty well. And here's your trend change signal right here, which would have occurred pretty much the same place where the rule of 3 failed. Okay, so the rule of 3 is called that because it's a rule of thumb. Sometimes your rule of 3 will only have 2 signals against the trend. Sometimes you will have 4. If you get to have 6 or 7 or 8, it's no longer a rule of 3. But the important thing is that it is always preceded by a retest and a failure of the high or the low. Here, technically, is a rule of 3, even though it only has 2 signals. There's 1, there's 2. But look at what happened. It had a retest of the low and the failure, right? The sellers we're unable to resume the downtrend. The market comes back, produces another buy signal. I would not necessarily take it on this signal right here. However, if it breached the swing high right here, I would take it. I would be more interested in taking it. So Marlene's question was, what about the red bar buy? Would you take the red bar buy? Yes, I would. Because the red bar buy, as I mentioned before, is the inverse of the green bar sell. At this point, I would have every reason to believe that the market would continue higher. Here's a red bar buy. Here was the first one. This is the second one. So it's still early in the trend. I would be believing that the market would still continue in my direction. If I used the ATR line as a filter for my entry, this would become my signal bar. So ideally, I would set up the trade to look something like this. So then the market brings me in, and now I'm looking to see how is the market going to react here. And now all of a sudden it's like, uh-oh, what's going on here? I'm getting a ton of heat. Okay, things are okay. And now it's, uh-oh. There's too much flip-flopping going on here. So I could choose to roll my stops at this point, because look at what's happening here. The buyers engaged the red bar buy. The sellers all of a sudden stepped up. So the sellers are getting more aggressive relative to this area right here. Buyers came back. They should have resumed the trend, but what happened? Uh-oh, the sellers came right back. Now let's say we didn't roll our stop. Let's say we held off, kept our fingers crossed. It's like, okay, well, here come the sellers now. Uh-oh. Okay, here come the buyers. This really is the last chance the buyers have to pull this market together. So, pardon me, I would start to roll my stops. And I would probably be a little bit more aggressive here, knowing that the market has already failed at this point. So you can draw trend lines across your chart and stuff. Sometimes the market will respect them. And knowing that, you know, we're struggling to get higher here, I don't necessarily want to leave my total risk open. Okay, so we just kind of keep pushing higher. Right now it looks like, okay, we caught a break. It was nothing more than a bull flag type scenario, a little bit more of an extended bull flag. We're going to be okay. And now it's, you could continue to roll your stop, or even if you, let's say you held it right here, and now all of a sudden like, uh-oh, the sellers have shown up again at the highs. So we're going to get stopped out here on the next bar, but again, we managed the trade to a point where we're not taking the whole hit. Remember, your stop loss is your safety net. It's nothing more. So had the trade reversed at this point and come down, and we had no second chance to get out of this trade, I would have got tagged for 200 and change. It's my safety net. It's not an amount I cannot afford. Yes, it is unpleasant, but at least I didn't blow myself up. As it turns out, the market did give me an opportunity to adjust the stops. Even if I didn't get my stops up to here, let's say I got them up to here, I lost about $100. So I still ended up losing less than my initial risk exposure. Marlene asked, do you ever adjust your profit objective? Yes, I will. If I do my best not to tweak myself out of a good trade, I do it a lot, and it can be frustrating at times. You know, we all have our bad habits. As a trader, that's my bad habit, is I'll sometimes over tweak my trade. But, you know, when this was shaping up, this was a reasonable target. there was no reason to believe that the market would not hit our high probability target. And then by the time we got this final reaction, it was too late to do anything about it. So short of taking break even or a smaller loss, there was not much hope for this trade. The only other thing that I'm going to point out to you with this particular trade, when we get the red bar buy signal, notice how far we are below the ATR. We know the red bar buy is a strong signal. We know it's a reactionary signal. But it's also a long ways to the ATR before we finally get our signal, right? If we wait for the ATR to flip, this becomes our signal bar. And now all of a sudden we're a good 5 points further before we even gain entry. Sometimes when the market is producing like this and the ATR is a long ways off and I'm relying on the probability of the signal to be correct, I may try to get in a little bit earlier, even before the ATR flips. Why? Well, because if the market's going to be retesting the high, right? It's in an uptrend, it is always retesting the highs. And every time it goes to retest the high, there's a chance that it's going to fail at the high. So in this case, logistically speaking, gaining an earlier entry would be to my advantage because it gives me a few more options trade management wise, right? If the market starts to flounder here, and let's say my initial stop was down here, I could bring it up to here and essentially be a break even. If I still continue to hold my stop and the market rolls out like this, you know, I've got a very secure swing point. And now instead of having 170 at risk, I've got, you know, maybe 100 at risk. Plus, I never really get into a good profit position here where I may choose to actually take some profit. All right, so those are your eagle signals. And I'll just wait a moment in case there's any questions about that. I'm going to go through the questions here. Yeah, Akeem, he says, good morning, Eric. Perhaps it's about time for a cheat sheet on the Eagle. I mentioned this before. The problem with doing a cheat sheet on the Eagle is I've never had a market segment where I could show you all the Eagle signals within one screenshot. So I may end up having to patch things together. But, you know, we review these signals every day in the room. And if you have questions about the signals, just ask. That's why we're here. And when the markets are dull like this, well, it's a great opportunity to review this stuff. And Bob, yes, we're going to do it for the Raptor here in just a second. Jim makes a good comment here regarding backups. He says, Eric, I got a virus and I'm rebuilding my CPU. Have everyone do a Ninja backup with all the templates and workspaces. I did not, and now I'm rebuilding everything. No trading at all, no income. Yikes. That's not good news. I'll show you what I do with my workspaces. I actually have, I do what Jim suggested. I have redundant workspaces. So I have my DTS and then I have my copy. And the workspaces, of course, are saved in the Ninja folder. So it's good to have some sort of redundancy there. And ditto with your templates. When you have your charts finally set up the way you like them, I like to change my colors from the stock colors, pardon me, my signal bars and whatnot. You don't need to. I'm only telling you what I do. But once I have it, I go here. Well, first off, I'll save the template. So I'll save it, and I'll save it as my Eagle. or call it whatever you want. This way, when you go to load a chart, all you have to do is put that template on, and voila, it will look just like that. And then once you have your trade manager set up the way you want, you can also save your trade manager through the template manager. You simply type in here on line number 2, save, you type in a name for your template and hit the enter key, and that's it. No, I know, Akeem. Akeem says, I was just referring to the cheat sheets you've done for the Hawk and the Falcon. If I ever see a screenshot where I've got a rule of 3 and a red bar buy or a green bar sell, a trend change signal, and a hard edge bounce all on one screen, I will definitely write it up. This one's pretty close. See that? Green bar sell. The green bar sell, did that one trip? No, none of these triggered. Oh, technically this one triggered. It hit the hash mark. So if you took it right on the hash mark, you would have taken a little bit of heat here, but here's the green bar sell that finally tripped and had some nice follow through. Now, this might be it right here. We've got a rule of 3. We have a trend change. We have a green bar sell. It's unfortunate that cloud flipped over a little bit. Kind of spoils it. All right, just double checking that I haven't missed any questions on the Eagle before we go into the Raptor. Okay. So now here we are with the Eagle, right? We're currently trading. The market's kind of dull, moving very, very sideways. We did get a red bar buy signal right here. It does appear as though we have had a retest of the low. It's kind of a protracted one, but retest of the low anyhow. I would definitely be interested in buying this higher. See how we have all the qualities here? You could have bought this red bar buy signal. I probably would have waited for the signal bar to come into sync with the ATR, so that would have effectively become my signal bar right here. And you can see a little while later we produced a another signal, another hard edge bounce signal right here. So regardless, it looks like we would be long on the Eagle, trying to get up there a little bit. So we'll see how that progresses. And in fact, we'll just put it on here and we'll see how it plays out. But here too, the market a little bit dull, a little bit sideways. You can see from your other tools, like just a mess. A lot of yellow bars here. No real follow through. So whenever you see that, remember there's nothing wrong with letting the market break out and retest. It's rare that you won't get a signal somewhere along the line. Okay. So now with the Raptor. Now the Raptor has been a little bit of an evolution, I have to say, because when we first put the Raptor package together, we were just looking at your basic with trend signals. The Raptor owners, perhaps more than the other DTS tools, have really influenced the way that we read this particular tool. For one thing, and I do believe Ben has made this change on the Raptor that comes out of the box now, but we normally put a double cloud on our Raptor. So if your Raptor has a single cloud, let me just go over very quickly how this is done. You're going to go here to your indicators window. you're going to pull down here. You're going to find where it says IW RTS Raptor Cloud. Double click on that and you're going to have two Raptor clouds in your indicator assortment. I've changed the parameter of 1 to 8 ticks, and then the other one left at the default of 12, but you need to change the color of the band. So choose whatever color you want so long as it's different from the stock color. And you also need to change your band color, your hard edge. All right, and once that is done, you can click apply and OK, and voila, you will have two bands. Now this was actually, Ricardo is one of our Raptor traders. This was his idea because he found that sometimes the market would come up short encountering the hard edge and yet produce decent signals. So he incorporated running dual bands, and it seems to have worked out very well. So, well, here, let's start with the more basic cloud crossover signal. The cloud crossover signal occurs when the clouds cross over. Actually, that one's not as textbook as I would like. Let me see if I can find you a better one. Sorry if I'm making anybody dizzy. Okay, here we go. This one's pretty much textbook. So the clouds change direction. You go from a bearish cloud to a bullish cloud. When this occurs, we expect the market to come into the cloud and the cloud to offer support to the market. In fact, I think it was Jim who first recognized this as a feature. And then what would happen is the market would bounce out of the cloud and produce a signal. Now, in this example here, you can see it didn't drift into the cloud very deeply, but I'll leave it to you to find examples as well. But very often, as soon as that cloud crosses over, the market will retreat into the cloud. That cloud will offer support, or in this case resistance, and it will come out and produce a signal. And that signal tends to have some decent follow-through to it. All right, so whenever the clouds cross over, you want to be alert for that signal developing. That's a very strong signal on the Raptor. The Raptor is also pretty quick in spotting counter-trend signals. And these tend to develop when the band gets overextended. So when the bands start to get very wide, there's an opportunity for a counter-trend signal. And in the case of an uptrend, we would call this a soft edge sell because it's occurring on the soft edge, and we expect the market to retreat to the hard edge. Now, this is not a very good example because a soft edge sell must always be preceded by a retest of the extreme. And the soft edge sell, you have to pay attention because this retest usually develops very quickly. This is not the best one. It's sort of a double top. Let me see where they finally end up going. Okay, this is better. Okay, now I haven't scrolled it ahead, so I don't know how it's going to play out. But you see how we've had a proper test of the extreme? And now here we are, and we come back with a sell signal. This would be a soft edge sell. Our target would be down here. It would be the hard edge of the band. The thing with the soft edge sell is sometimes it can make a very strong move the other way, far exceeding the hard edge. So let's see how this played out. Did it go down? Well, it tried, but it didn't make it all the way to the hard edge. But this is what we're looking for when we're doing a soft edge sell. Needless to say, counter trend trades are always tricky. Okay, here's another nice little soft edge sell. Ideally, with the soft edge sell, this little retest develops, like I said, very quickly. It's usually only a few bars, pardon me, only a few bars between the retest. In fact, you may even consider this a retest. Stop it. So this one, we've only got like 1, 2, 3 bars after this little retest. This one's a little bit more protracted. This one has 1, 2, 3, 4, 5 bars. This one back here had about 10 bars. So the quick ones are the ones that tend to have more follow through if it doesn't make a liar out of me. Oh, there we go. Oh, whew. Okay. So you're looking for that quick little retest, a failure, and you're anticipating that the market's going to go to the hard edge. That's the soft edge sell. All right, so we've got the cloud crossover. That occurred right here. Again, not a real big retest. The cloud crossover, I would have anticipated that this bar would have had more follow through, and our cloud crossover would have looked more like that. But it came a little bit late. This becomes our cloud crossover signal. So there's a couple of Raptor signals for you. Now, the Raptor also has the hard edge bounce. Normally, I like to see a double pullback into the hard edge. So I prefer to see the market move into the hard edge, come out, move into the hard edge, come out, and then I'm going to get more aggressive about selling. Ricardo is more aggressive than I am. He'll just take the hard edge bounce. The market comes into the hard edge, comes out, produces a signal. He's already short. Now, it's not a bad way to go because in most instances, you'll at least get a scalping profit. Marlene, and speaking of which, Marlene asked, what is your target? Typically, I'm using the same target as I would on the Falcon, $100 per contract. In the case of the NASDAQ, that would be 20 ticks. So, like I say, Ricardo's a little bit more aggressive. He'll wait for the market to come into the hard edge. He'll look for that reaction, and he'll already be short. He'll already be short right here, and he'll already be short on this one, and he'll already be short on this one right here. And he'll do that all day long. He'll just look for it to hit the hard edge, come out, produce a signal, and away he goes. And like I said, to pick up a scalping profit, probably not all that difficult to do off that type of signal. Again, with the Raptor, the more times a signal repeats itself, the less likely it is that it's going to have any duration to it. So you don't want to see hard edge bounce, hard edge bounce, hard edge bounce, hard edge bounce. Because remember what happens every time the market retreats into the hard edge. It's showing, in this case, a lack of downward momentum and increasing upward momentum. And if you do the little connect the dots game and you connect your lows, it becomes a little bit more obvious that we're starting to get a little bit of a sideways drift going on here. And then the market starts to take off the other way. All right, so pay attention to that. As with most things trading related, you want to be early. You don't want to be late. By the time the market produces the third hard edge bounce and comes out with a signal, the people in the know are already buying. You don't want to be selling. So if it looks to you like the signal is starting to get tired, just leave it. It's okay to miss a signal. Let's see, what am I missing? I feel like I'm missing something on the Raptor. We did the hard edge bounce, we did the cloud crossover, we did the soft edge buy and sell. I guess actually that's it for the Raptor. It's usually enough to keep you out of trouble or in trouble, however you want to look at it. With the Raptor also, you want to look at the context like with your other tools. So if you got a market that's producing a lot of yellow bars, you're getting a lot of sideways drift, just recognize that the market is balanced. It's no fun to trade, but the market is very content. You cannot make the market do anything. Your job as a trader is only to take what the market is offering. One thing that I do try to look out for is swings relative to each other. Where is the market making swings? So we had a high here and the market broke out right here. Ideally, this retest should not have drifted too deep into the trading range. Because it drifted rather deep into the trading range, it just contributes more to the overall sluggishness of the market. But let's pretend for a moment that it didn't drift all that deep. And it comes out and it produces a buy signal. Would I be interested in taking that buy signal? Yes. Why? Because we breached the high. We've breached this other significant swing high. Now, we don't want to start micromanaging this stuff, right? We don't want to look and say, oh, hey, this bar breached this swing high. Or, this bar here breached this swing high. We don't want to micromanage this stuff. We want to go for the obvious. If you showed this chart to a kid and said, show me the obvious swing points, assuming he knew what a swing point was or she knew what a swing point was, they would probably label this as a swing point. Okay, so we've breached the swing point. Why is that significant? Well, when a market violates a significant swing point, either higher or lower, we can normally anticipate two moves in the direction of the breakout. This is move number one. Therefore, now I'm on the alert for move number two. And this is a universal concept. It doesn't matter whether you're looking at the hawk, the falcon, the eagle, or the raptor. This is something that will occur all the time. In fact, you could even do it on your daily chart or your weekly chart. If you're consulting a longer time frame or you're doing some end of day trading. If the market violates a significant support or resistance area, it will likely follow it up with another move in that direction. Generally speaking, the first two moves will be the strongest. So here's move number one. Now here we are producing a signal. This is now move number two. So that's what makes this a better buying opportunity than perhaps trying to buy in here, right? Again, you want to get in early. You want to look at the overall context of the chart. And, on a day like today, things are unfolding rather slowly, certainly slow enough that you can look at this and you can think about it for a while. And you can think, you could even let a couple bars pass here and you could think, I bet you we're going to make a second leg higher, right? So that's what makes this a good hard edge bounce to buy. Buying this hard edge bounce down here, in hindsight, you would have looked like a rock star, but as it unfolded real time, let's clean this up here. As this unfolded real time, I really had no reason to buy that. If anything, at this point, I might be thinking, We're going to get a cloud crossover here to the short side. I'm going to see the market retest the lows around 44.62. I'll wait for the cloud crossover signal and for a chance to short. And as it turns out, it starts going the other way. Okay, so we're going to try to break out above the highs. Oh, the breakout failed, comes down, hard edge, and now it's, okay, what do we have now? We're making higher swing lows. We've breached a significant swing high. We might get another push higher. Logistically speaking, even if this market goes up and decides to fail as it retests the high, we have some room in here to move, right? We have either room, if you're going to take more than one position, you certainly have enough to get at least a scalping profit. Maybe put one in as a scalp profit, leave one on as a runner if your account size allows you to trade 2 contracts. But even here at this point, once the market starts to retreat, you do have options to adjust your stops, right? If it looks like the market is going to fail, if this is starting to look like a retest of the high, you don't need to wait to be stopped out way down here. You can at least bring your stops in a little bit. If you're thinking, okay, well, the buyers are going to try to recover it somewhere through here, you could leave it below the first hard edge in case the market drifts to the hard edge and tries to react. But there is a very good reason to believe that the market is going to try to rally off of that signal. And as you can see, there it goes. Same thing with what we were looking at here on the Eagle, right? We had our retest of the low, even though it was a rather drawn out one, it was still a retest of the low. Our band is now bullish. Technically, we had our first with trend signal here. I would have been a little reluctant because at this point, we didn't really see the retest of the low. The retest of the low didn't come until right here. Actually produced a red bar buy, waiting for the ATR to come into sync, which at this point may have been a good idea because, hey, when that's unfolding, yeah, it's a red bar buy, but the market may end up drifting and making a more serious retest of the low. So even though the ATR is a long ways off, I may choose to let it flip. Okay, it flips. It looks like the market is stronger now. And even if you missed that, you did get your with trend signal right here. And you can see at worst, we've hit our break-even trigger. Otherwise, you could have even brought your stops up to here a little bit. But you can see it was a high probability signal all the same. Now, of course, had I taken the signal on the hash mark here, we would have already hit our profit objective. So it's always a little bit of a trade-off when you're delaying your entry. Remember, the high probability profit targets are based on the hash mark. So whenever I delay my entry like that, I suppose I should adjust my profit objective accordingly. So I could have, when I delayed my entry, I could have done that, I could have done that, and I could have still gone to 44.90, in which case I would have banked $140. But that's something to bear in mind. The high probability targets are based on the hash mark location. So that's what I look for when we're trading these tools. We're looking for how prices are relating to each other. At the very least, you want to pay attention to the swing points Does it look like the market is swinging higher? Does it look like it's trying to swing lower? What happens when a significant support or resistance area is violated? Does the market recover? If it does, we can usually anticipate one more move in that direction. The nice thing about trading is that you can do all these things in hindsight, right? You can go back into your chart and you can say, okay, here was a significant support zone that got violated. And you may choose to count it differently than you're seeing me do here, but there's push number 1. Here we come back with the signal. This is now going to be push number 2. Even if you didn't count that as push number 2, let's say you counted this as the move that violated the signal, or violated the support zone. What are we expecting, class? What are we expecting when we breach a significant support area? Now I'll see who's been snoozing. That's all right. I'll give you time to type for you hunt and peck typists. The market has just breached a support area. What are we looking for? Come on, you guys. We just went over this. It's important that you learn this because I might want some time off from time to time. Yes, very good. Give yourselves a pat on the back for those of you who said you need a retracement. You need a retest. You need a retest of the support area. And here comes our retest. Don't worry if it doesn't get all the way there. You can see that there's some subsequent support areas that traders may have relied on. Here's our retest, and here now is our corresponding signal. So is this a signal I would take? Yes, definitely. And I would probably risk it at least above this high. If I could afford it, I'd risk it to the other hard edge. Remember, my initial stop is only a safety net. It's not there to give me some sort of risk-reward ratio. It's only to get me out of trouble if the market totally reverses on me. Just makes some huge unpredictable move. All right, any questions on the Raptor? We haven't really missed much. Oh, crude oil put in a nice little rally. Tony alerted me to this earlier, but I was in the middle of my little spiel. Unfortunately, we didn't get a decent signal here on the Falcon for crude oil. The signal produced rather late, which is unfortunate. That's rare, but it does happen. Pretty sure we would have got a signal on the hawk. Yeah, there it is. Nice little first micro-macro cross just at the beginning of that run up. And there we go. Now here's a macro pullback signal. Why might I be a little bit suspicious of this macro pullback signal? I'm not saying I wouldn't take it. I'm just saying, why might I be a little bit suspicious of this signal? What's going on here that might give me pause? Yeah, not bad. Marlene says it hasn't moved close enough to the macro line. Yeah, that's a consideration. Technically, it is a macro pullback signal because our micro line is out of sync. Notice what preceded it. We've already got like a little double top or a little failure here. So if I choose to buy in at the hash mark, and let's say I choose to risk it to the macro line, even with my, well, I've doubled my scalping profit, but let's say even with my doubled profit target, I need the market to exceed the highs in order to reach my profit objective, and yet I've already seen it stall twice before hitting 39.05. So there's really not that much in there for me to realize my profit objective before the market potentially reverses on me, which I suppose goes hand in hand with what Marlene was saying. It would have been a better trade had it retraced a little bit deeper. It's not to say that it's not a macro pullback signal, but the signal itself, I don't have a whole lot of room. The market's already showing some sensitivity there. So if I'm going to take this signal, again, I need to be aware that that could be a problem. Maybe I'll dial down to my high probability target and just take $50 out of the trade, because shoot, crude oil will do $50 in a heartbeat. See, there you go, $50, and then it reverses. So that's something to consider here. And again, you know, the signals unfortunately are not 100%. Here's a macro pullback signal that actually looked fairly promising. It looks as though the market has, you know, is waffling. It's moving higher, it's moving lower, it's moving higher, it's moving lower, no real defined direction. It may well try to retest these lows. Even if I shoot a trend line across the lows here, I still have lots of room to try to get in here, even with my double profit objective. Short here, cover there. I got lots of room to try to retest these lows. That is not a bad looking macro pullback. Unfortunately, it brings you in and turns on a dime and stops you out. So if you took that loss, there is nothing you did wrong on that trade. There was no real way to see that one coming. You know, the market violated the swing, it retraced. We're anticipating two moves in the direction of the breakout. Who knew that this was the second move right there? I didn't. I would have fully anticipated this trade to work out. So don't beat yourself up if you take a trade that does not work out. Occasionally the market is going to toss you one of those, which again is why it's so important to keep your risk to an acceptable level. I mentioned this the other day about Richard Dennis and the turtle traders. One of the things that he did so well was money management. His signal was so simple. It was just a basic breakout signal. He ran enormous stops. I run big stops. You think I run big stops. He ran huge stops. And he was quoted as saying, if you want to earn big profits, get used to taking big losses, because there's going to be times when the market is going to reverse against you and it's going to stop you out, and it's going to be a bit of a stinger. But never, ever did he risk more than 2% of his capital. So even though his losses were significant by our standards, it was never more than 2% of his trading capital. So when he hit those big trending trades that would trend for weeks or months or sometimes even years, he would make it all back and then some. And he had a very sophisticated methodology, for adding to his positions, so that when the market was advancing in his direction, he kept adding to it, adding to it, adding to it, so that it would keep earning him more and more and more. That's something that's not as easy to learn. It's something that we don't do very often here in the trading room. Very often we'll do the simplified version of just setting our total risk exposure up front, right? We set our 2% risk. We look at our signal. Where's our signal? Here, first micro macro cross. So we go in here, we cover here. This is my maximum risk exposure. So I'm already leveraged to the max. What somebody like Richard Dennis might do is he would perhaps start with one contract, and we're going to change this to a runner position. So he may start with one contract, and then when the market broke, he would add another. And then when the market broke again, he would add another. And then when the market broke again, he would add another. And so long as the market kept moving in his direction, he would keep adding to his trades. Now, it's all well and good so long as the market is advancing, but let's say at this point the market reversed and comes down here and stops you out. Okay, let's say we got to break even on the first position. You still took a loss on the second, right? Because you bought into the second one right here. So you bought your first one right here, bought into your second one right here. Even if you got your first one to break even, your second one you still took a loss. So it's not like that type of thing happens all the time. But when it does happen, it can be incredibly profitable. So you may want to follow this through for the rest of the day, just so that you can see for yourself. And again, this is a great game, a great exercise that you can do on your own to see the value of it, to see how it might work out. But now we have 3 contracts earning money. Well, the third one is still hovering more or less where we bought it, but we've got, it looks like about $100 or $200 open profit on the first one. Well, sorry, actually our very first one is down here. Sorry. So it looks like we've got about $150 on the first one, an extra $100 on the second one, and maybe about another $50 on the third one, and the fourth one hovering around the same price where we bought it. So we're currently up about $250 if we punch out of the trade right now. The problem is, what happens if the market turns and starts coming down? Well, you've got this one losing money, and you have these 3 earning money. Well, this one's essentially going to be break even. So when the dust settles, let's say we get stopped right here. We've had earnings on this one, looks to be about $100. We've had earnings on this one, looks to be about $50. So we have about $150 in earnings. It looks like we have about $100 in losses. So we walk away with $50 for all our effort. We've bought 1, 2, 3, 4 contracts. We're going to owe half of that to the brokerage and the exchange. So for all our trouble, we make $25. Whereas if we had just gone all in, all out on the first micro macro cross signal, oops. So we go all in, all out. Oops, sorry. Had we gone all in, all out, we would have made $100. Right? So it's always a trade-off. I do like having a runner in play because you never really know when the market's going to bolt. Sometimes there's clues. Um, the market, before it rallies, either higher or lower, is always preceded by a very dull period, like what we're seeing right now. The market is going to come out of here. We don't know whether it's going to go higher or lower, but when it comes out of here, it's going to catch some fire and it's going to go. Just because it's been so dull and so congested and so sideways for the last 2 or 3 days. But we don't always know when that's going to happen, and we don't always know how far it's going to go. Yes, there's certain things that you can do to try to predict how far the market's going to go. One of the things some traders like to do is they like to do what's called a measured move, where they'll look at things like, they'll say, okay, well, that was that leg there. If we break that leg, then that's how far the market should go. Are we there yet? No, not yet. So some traders are looking around the 44.98 area as a probable profit target. Like most things trading related, it works until it doesn't work. So even though very often if you have a market that's advancing quickly, a runner can be very profitable. A lot of times you'll do just as well to bank your profit when you have it. Certainly banking your profit when you have it, being all in, all out, really simplifies your trade management, right? There's nothing to managing a trade when you're all in, all out. If we were in this position where we bought here, bought again above there, bought again above here, bought again above here, this is a management nightmare. Right? But if you're Richard Dennis, you've got a break-even stop at best. Actually, his stop is probably still way down here or lower. He's probably even below the daily swing low or yesterday's swing low, whatever the case may be. That's how he would trade it. I don't know if I could do that. So at the end of the day, I suppose you got to find something that you are most comfortable with because, hey, it's your money, right? I can advise you, I can show you things, I can give you my best opinion, but at the end of the day, it's your money. Only your opinion matters. Tony asks, Eric, where do I go to watch this session again? What you want to do is you want to go to the Indicator Warehouse YouTube channel, and let me find you that. Stop it. Stupid computers. I'm trying to... Okay, here we go. So Indicator Warehouse actually has a YouTube channel. So youtube.com. Oops, well, stop the little commercial that he has. And if you go to YouTube, just search Indicator Warehouse. And the trading rooms are updated daily. It looks like it takes about a day or so to get everything uploaded. All right, so that's where you can go for that. And it doesn't look like too much is going on here at the moment, so we're going to close down early. Marlene asked, if you can't trade in the morning, is the afternoon more dangerous? No, not at all. Sometimes the best moves will come in the afternoon, especially toward the close. The close is when the market tends to get very active. And a lot of times when the market is dull like this in the morning, we may see a better move in the afternoon. No, afternoon trading is just fine. Again, it's just a personal thing with me that I prefer the morning session, but a lot of times I'll trade the afternoon on my own. Try to pick up a couple of decent trades. So as quiet as the market's been this morning, I wouldn't be surprised if we saw something happen in the afternoon here. Maybe see the markets trickle up to that 4,500 area. That's entirely plausible. All right, you guys, we're going to shut down the room then. Oh, Tony asks, how late do you stop trading in the afternoon? Well, the market closes at 1:15 my time, so I usually, if I haven't seen a decent move around 12:30, 1:45, I try not to trade into the dying minutes. Just like you have the opening range, closing range is about the last 30 minutes. But I always go back to the chart itself, right? It's the signal that's the most important part. So if we go back here to yesterday, so here we are. This is at the top of the hour, 1 o'clock. There's only about 15 minutes trading left, but it's looking like, hey, maybe there's a decent scalp opportunity here. It is a first micro macro cross. I can cover it relatively tight. It never hurts to jump in, and I would have hit my profit target about 5 or 6 minutes later. Obviously, I don't want to be in an open position as the market closes. So if you don't think your position can find its objective in 10 or 15 minutes, don't take the trade. Because then you're going to be on the hook for the full margin. Yeah, that's right. You want to be out before it closes. That's what Tony says. Absolutely. Generally speaking, if you stop trading a half an hour before the close, you'll never have that problem. All right, you guys, have yourselves a wonderful day. We'll be back Friday. Hopefully the market will be a little bit more responsive, but we'll see. We can only take what they're giving. All right, we'll talk to you tomorrow then. Bye for now.